And this is for Professor Zhang's class, Management 310. And this is Session 8 assignment. We're supposed to investigate market efficiency using the GameStop GME short squeeze event of 2020 and 2021. And then for the first part, for define and discover, our goal is to establish the scope, objectives, and initial data requirements. Our primary goal of this case study is to investigate the GME short squeeze to assess market efficiency and evaluate the role of behavioral finance. Some key questions to ask: was the initial price statement of 4 cents in August 2020 accurate? Which form of EMH was potentially violated? And could a rational investor have generated systematic risk adjustment abnormal returns? And then discover an initial data check. Immediately create a reliable financial data source for GME's historical trading data from August 2020. And then we're supposed to verify the accuracy of the 4 cents in August 2020, but the actual price was likely to the $4 to $6 range. So it was incorrect, 4 cents. Next step is to represent our data requirements and acquisition plan data points, GME price and volume, S&P 500 or Russell 2000 market returns for abnormal return calculation, the historical short interest data for GME, and the relevant news social media sentiment data. Supposed to figure out an EMH testing, use auto correction of daily returns and risk tested to check for non-randomness or predictability and past price data. And then we're supposed to identify map behavioral biases, herding, available bias, and confirmation bias. For the I, we're supposed to execute the planned analytical models using the acquired data and Python code. And then if we have this code down here, here's all the code over here. If we look at some individual things, the code GME analysis P1 PY loads the necessary libraries YFinance to download data for the manipulation for plotting. Some other ones, fetch and verify data, is fetching data from other websites like Yahoo Finance and figuring out the different prices. Like GameStop traded at 4 cents in August 2020, but that was incorrect. It's an incorrect statement. It traded at between $4 to $6 range. And then the calculate returns is just calculating. In finance, log returns are preferred over simple returns because they're additive, making cumulative calculations easier and better approximate continuous compounding. As we move on to the E portion of driver, the EMH violation conclusion, the strongest conclusion, the event primarily violated the semi-strong form EMH because the price 483 severely deviated from the public fundamental value to 10 to 40 range. Weak form check, if the time series analysis showed non-random returns during the event, it also points to a weak form violation. The strong form check, the fact that insiders and retail traders had information coordination not available to the general public or institutions, suggests a violation of strong form efficiency as well. For the behavioral finance assessment, herding and social media conclude that the GME event is a classic example of crowd behavior driven by social media. The large volume spikes confirm herding. The rational investor profitability conclusion ex post, looking backwards, systematic profit was possible for those with superior information or coordination. However, ex ante, a rational risk-averse investor could not have reliably predicted the timing or magnitude of the squeeze, thus preventing systematic risk adjustment profit. The high volatility implies the risk returns came from unacceptably high risk. Now for the R, report and refine. Key takeaways: the GMA short squeeze represents a severe, short-lived, semi-strong market, not only driven by a combination of high short interest and social media-driven herding behaviors. While EMH defines the price. The framework preference, while EMH defines the price as a massive mispricing, the behavioral finance framework is better equipped to explain the mechanism and duration of not only the herding plus limits to arbitrage. Policy implications. The event highlights the need for reviewing rules around short selling disclosure, trade settlement times, and the ability of brokerages to restrict trading. So limitations in future work. Some limitations, the current analysis is based on daily data. Intraday data would provide deeper insight into the speed of price changes. Statistical significance testing was optional, so it's basic here. The refinement future work could involve building a regression model to more rigorously estimate the expected return and calculate abnormal returns with greater precision. That's about it.